Hello, fellow traders. Mark Abramsky from Forex Undressed. We're just going to break everything down from the past week, and we'll be looking at this week between the 23rd and the 28th to give you an idea of what I see in the markets, where I can see price going from here, and why. Of course, we'll look at the U.S. dollar, Euro-U.S. dollar first. Not a real big surprise. You can see it is still moving down. I did expect it to make a little bit more of a move up, but it hasn't, okay? That's the reality, and it's probably going to come down to at least the 12245, if not a little lower, over the next week or two. That's in relation to the dollar index, of course, breaking out to its range, to the upside, of course, which will force the euro down because they're two very highly correlated currency pairs. How we play that is basically short the euro US dollar. So if it manages to make its way, creep its way back towards the 23.6 Fibonacci here in this particular area, and that would be roughly around the 2489 area, it's a selling opportunity, obviously. Conversely, with the US dollar franc, it's a reflection of the dollar index. It is a buying opportunity, and it's probably going to come up towards this previous high here. You can see all the major sort of resistance areas over the last few years. We're at one now almost, but it may make its way up to the 9918 area. It probably will. Looking at gold, gold has once again pushed up to the 1206 area. Once again, more order flow related. It still has to get by this minor trend line before I'll give it any sort of weight, maybe up towards the 1248 area, perhaps slightly beyond. Right now, it's kind of rising with the dollar, which is unusual. Okay, but however, it's order flow related, and yes, that's what it's doing. As we look at silver, making a very similar pattern, it seems to have bottomed out at the $15 area. The cost for silver, actually to mine it, is up around the 21 area, so it's actually quite a ways below cost to mine the stuff. Oil is the more significant pattern here. You can see we have an inside weekly bullish candle, from the outside, bearish here. That generally means a continuation pattern, folks, okay, to the upside, all right? Remember, I've been calling for around the 79 to 81 area, maybe for a retrace up. It actually could be the start of something a little more powerful, too. So once again, I've been telling you to buy at this particular area, and it seems to be a very good idea, not just fundamentally, but technically. Also on the 27th, which is the Thursday of this week, we have the OPEC members coming out with their cuts to production, of course, to try to jack the price back up. Once again, it isn't very efficient for price to be down here for the oil producers or for the corporations for their refining processes or their exploration process. It needs to be up in this area here. So, once again, over time, perhaps, a good area to consider oil as a long, maybe it'll work its way back up towards the 91 area. Treasury bonds, the 10-year isn't much really surprise. There's sideways movements, not much of a yield. The Nikkei 225, of course, the Japanese index is rising up with the US dollar, Japanese yen. Should climb up towards the 18,000 mark, I would think, over the next month or so. Simply a reflection of all the indexes right now is the funny money. Just keeps getting pumped into them. And of course, the cash flow around the world, where there isn't much else, that fund managers are looking at right now. The U.S. economy, be it ever so shaky, is probably the best of all the G8 countries. So of course, you get the Nasdaq racing higher, which is what we have here. Even if there is a bit of a move down, it's more, an opportunity to buy, folks. I'll be the same thing with the S&P. If it moves down, once again, more of an opportunity to buy. It's still staying within its channel, upward channel that it's been in since pretty much 2009. The Dow, the same, I'll be looking to buy these indexes, all of them, you want to have some exposure because they just keep going higher. No sense fighting the trend. They could go an awful lot higher too, maybe 20,000 by January for the Dow, so the pound seemingly has bottomed around the 155.89 area. I would look for this to be the basically basement for a little bit of time as it maybe makes its way back up slowly, very slowly, anemically towards maybe the 1.63 area over the next 3 or 4 months, so it isn't going to be a very fast process there, fellow traders. As we look forward, the Aussie may have bottomed in relation to oil getting a little stronger. Of course, the People's Bank of China, dropping interest rates, which of course, because they're commodity-based currencies, may be a reflection where some of the larger traders will step in here in this area now and buy the Aussie for a carry trade, even though the dollar is strengthening at the same time. You would think it would be an easier task right now for the Aussie central bank to push it lower. Not necessarily if you have a number of carry traders that jump in at this particular level. It could conceivably go back to the 0.9075 area here, So something I'll be keeping an eye on. Same thing with the New Zealand dollar against the US dollar. The Canadian also strengthening as a result of oil strengthening too at the same time. And of course, the fact that it's a commodity based currency, once again, as the People's Bank of China begins to try to stimulate borrowing and whatever else, of course, the Canadian may strengthen back down towards the 1.0981 area so that it doesn't get too weak, even though Governor Politz, who is the central banker of Canada, wants to see it weaker. It didn't necessarily close below the areas I wanted it to. However, we could conceivably see it move down over, I would say, a period of a month or two towards the 1.0981 area. We'll keep an eye on that. It seems to have topped out in the 1.1457 area. The US dollar Japanese yen, of course, is the big one that everybody's looking at right now, and there seems to be no signs of its slowing momentum, folks. You can see where the next significant resistance point is at the 120.54 area, and it really hasn't slowed down much since the 78 level way down here, So you can see it's pretty parabolic, which is how strongly the yen has been devalued. This is the area, of course, that the Doge likes it in, maybe even a little higher. So there's no reason to believe, even if it gets a little pullback to the 115 area, that it's not going to make a move towards the 120 area. So don't worry about any sort of little pullbacks. They're buying opportunities in that particular currency pair, folks. And that brings us to a close for the week. The three main currency pairs that I'm looking at once again are the Euro US dollar on a sell, the US dollar franc on a buy, and of course the US dollar Japanese yen to buying the dips that way. Those are the strongest particular currency trades that I would be focusing on both fundamentally and technically for moves higher over the next month or two, as we continue to ride out the bull trend in the dollar index. And you can see here that that's exactly what happened with the dollar index. You can see that the corner trade worked out very well. It moved the dollar above these areas here, that's right above pretty much the 88 area, where it's been sideways for a while between the 87 and the 88 area. It just broke above it and closed above it. That's a factor, okay, because it's probably going to keep going higher, maybe to the 89.50 area, which is going to carry the US dollar franc higher and the euro US dollar lower, okay? And of course, probably the US dollar Japanese yen in the days to come. So it is a factor, and you can see that the bullish trend is still very much intact. So once again, it just simply comes down to when the deflationary effects of having a strong dollar are going to be too significantly powerful for the U.S. economy to handle, where, once again, it sort of reverts to the mean where the dollar starts to fall again. I don't think that's too far away. So once again, it's not the fact that the structural imbalances of the U.S. have gone anywhere, or the debt levels. They're still very high, so it means that you can't have too strong a dollar or too high an interest rate, folks. It's just that simple. So although the fundamentals would dictate a stronger dollar, there's no doubt about it. Compared to the other G8 countries, the U.S. is pretty much, in much, much better shape fundamentally as far as economic indicators are concerned, or leading indicators that way. So once again, that brings us to a close for the week. That's what I'm looking at. And we'll see you this week in the trade room.